What's up guys, it's Nick here, back with another real estate video. I've been an investor in real estate for almost a decade now, and whenever you invest in real estate, people want to talk about it. Investing in real estate is sexy and everybody wants in. They'll always ask you, oh, how's your real estate deals doing? They always want to know, and they think you're just rolling in cash. That if you invest in real estate, you just make tons of money, and you can. And I've been very fortunate in the deals that I've done to make good money, but when they're talking about, what they're really talking about is the cash flow. We're going to talk about all the different ways you make money. Today we're going to do a deep dive on cash flow. But when people ask, hey, how's the real estate going? What they're thinking is, how much money is coming into your bank account? So we're going to talk about this. We're going to take a deep dive, get into the nitty gritty. But before that, I just want to kind of do a basic overview of what cash flow is, almost from a 1,000-foot view before we dive into the specifics. So cash flow, a lot of people will say, is the most important metric and the most important way you make money in real estate. And I think what they mean when they say this is it's the one you have the most direct control over, right? Appreciation is kind of out of your control. You can buy in a good area, and hopefully that's an area that's going to appreciate in the long term, but ultimately it's out of your control. What you pay down in principal every month is based on the bank's amortization and the rate you get. You may be able to shop around and get a slightly better rate, but the rates are kind of what they are, and the principal pay down is going to kind of be what it is. There's not much you can do to directly affect that. But cash flow, the price you buy the property at and what it will rent for, you have direct control over that each deal. So you know, when I buy it for this price and it's going to rent for this price, I know my cash flow is going to be X. You have the most direct control over it. And I think that's why people say things like cash flow is king, or the most important thing about investing in real estate is to make sure you have good cash flow. That's what they're talking about. It's in your control. If you get that one right, the rest will kind of take care of itself. So with that, let's jump in. Now, as I described in my last video, that was kind of an overview. All cash flow really is what you bring in, your income, what goes out, your expense minus your expenses, and whatever's left over, that's your cash flow. It's really that simple. People try to convolute it, make it really complicated, and we're going to get into some of that, but it's really that basic. What you bring in, what goes out, what's left over is cash flow. Okay, now the mistakes I see when I see people talk about cash flow is they either make it way too simple or they make it way too complicated. And the truth is, reality is somewhere in the middle. So we're going to jump into that. The first thing is here, income. When you're investing in real estate, you've got different ways of making income. The most obvious is rent. That's what everybody thinks about. But there are actually other opportunities to make money in investing in real estate. I listed a couple here: late fees. You could have like a coin laundry system if you're on if you're buying a multi-unit. You may have a vending machine. You may have bill back your tenants for water utilities if it's on one central meter. So there are different ways, and you need to account for all that income when doing a cash flow calculation like this. So first your income, get all that, and next your expenses. Now this is where we'll get into some of the acronyms and things like that, but just to list a few expenses. Your PITI, which this is your mortgage payment, so this stands for principal, interest, taxes, and insurance. Usually when you buy a property, they'll roll all of that into one payment. So on your house, you may pay one payment, and included in that is your taxes and insurance. And what you're doing is you're paying 12 times 1/12 of your taxes and 1/12 of your insurance to the bank. And then the bank is going to take that money, and once a year, they're going to pay your bills for you. Okay, that's all that's happening there. But they roll it into one payment, so it's nice and easy. The principal and interest, that's on the money you borrowed, okay? So we call that PITI in the real estate world, and you can impress your friends with that acronym. The next thing is vacancy. That's the amount of time your unit is not rented. So when you own a rental property, it's not going to be rented 100% of the time, every day of the year for forever. So there's going to be a percent. Usually this is expressed as a percent of vacancy. So that's how much time it's not being rented and the lost rent from not having it rented. And then some people will include repairs here. That's usually if they include something else, they'll include repairs. And this is basically the stuff that comes up that you aren't aware of or you can't plan for. These are the surprises. Think of it as a birthday party surprise, right? There's a leak under the faucet that needs to be fixed, or a pipe froze and burst, things like that. And then the last one we're going to spend most of our time on here is CapEx. Again, that's a fancy term. It stands for capital expenditures. And when you think of CapEx, what this really is this is like Christmas, okay? Not in the sense you get presents, but it's like Christmas, and it comes around the same time every year, like 25th of December, and there are people that are surprised by it every year. It's here again. Oh no, it's Christmas. I have to spend money for presents. I have to spend money on parties and all these different things, and I didn't account for it in my budget, but it comes the same time every year. You should have known about it. That's what capital expenditures are. These are things that you know you're going to have to pay for and replace on a predictable time schedule, and accounting for them up front so that you're making sure they're worked into your numbers. So you take all these four things, PITI, vacancy, repairs, CapEx, subtract them from your rent and other income, and you're left with your bottom line, and that's your monthly cash flow right there. Okay? Now this is where a lot of people get hung up, is CapEx. So we're going to take another look into that more specifically here in a second, but I want to give some examples first. So what I said before is I see a lot of people oversimplifying this process of calculating. And what I see them do is they'll put rent, say it's $1,800 a month. They'll go, my place rent's for $1,800. My payment on it is $1,500. And they'll just stop there and they'll say my cash flow equals $300. Which is great, except they're not accounting for vacancy or repairs or CapEx. And when these things happen, like we talked about they will, especially with CapEx and vacancy, they're surprised by them and it eats into this cash flow number and they're sad about it. It's understandable. So that's one of the mistakes I see people make is they oversimplify it. They go, oh, rent, payment, that's my cash flow right there. And they're missing out on a bunch of things like vacancy, repairs, and CapEx that are going to eat into that quote-unquote cash flow of $300. So let's take a look at CapEx, okay? So here I'm going to run you through how I calculate CapEx. I try to keep it simple but also accurate in reflecting the costs that are going to arise from owning a home. So the three major things I like to look for is the roof, the water heater, and HVAC system. Whenever I am potentially putting an offer in on a property, I ask for the ages of all these. How old's the roof? How old's the water heater? How old's the HVAC? Because that lets me know on a timeline how soon I'm going to need to replace these things. There may be other things in your market that you need to take into account. And that's why just jumping in and learning your market and doing it is the best way to learn how to get these numbers, okay? I'm going to show you how I calculate with my numbers, but it could be very different depending upon your area. So for the roof, some areas, you may have a roof that lasts 20, 30 years, and so you can take the price of the roof, divide it by 20, 30 years, and figure out how much a month you need to put aside. You may have a metal roof on a property. In that case, metal roofs can last almost forever. So you may never have to repair it. But I'm in the North Texas area, and we're good for a hailstorm every 5 to 7 years. And that is going to wipe out your roof, destroy it, and insurance is going to come in and pay for a new roof for you. You'll owe the 1% deductible, so on a $300,000 house, that's $3,000. Okay, so that's going to be every 5 to 7 years. So we'll go ahead and take 5, so we're going to divide that by 60 months. And that's going to work out to $50 a month. All right. Next thing I do is water heater. So water heater, they cost about $1,200 for a nice single family sized one. Divide that, they last about 10 years. Divide that by 120 months. And that's going to give you $10 a month. All right, and then with your HVAC system, a good unit will cost you about $7,000. Those are good for, again, 10 years, 120 months. That's going to run you $58 a month. Now, there may be other costs associated that you can put CapEx. Anything that's predictable happens at the same interval predictably, you need to put in there. So like HOA, if your property's in an HOA and you pay for it, not the tenant, you'd include that. Or a condo, they have HOAs usually that are pretty high. You need to account for that in here as well. There may be other expenses if you live up north. I don't live up in the north, but you may have like a snow shoveling expense or something like that you need to take into account here. Anything that happens predictably, that goes here. And that's all that CapEx is you're accounting for those predictable costs over time and know that they're going to be a certain amount. So right here we have, with these three, for this example, we have $118 of CapEx. Okay, so now let's bring it back over to the example we were doing before. Okay, we have rent of $1,800. Your PITI is $1,500. And now for a vacancy rate, let's use 5%. So that's going to be $90 a month. And how I got that number is it's just 5% of 1 month's rent. Okay, because we're doing it on a monthly scale. Your repairs, let's say this is a brand new house, you're only thinking $50 a month, okay? And then CapEx, we'll use the number we calculated here, $118. So now instead of your cash flow being $300, you take your $1,800, you subtract the 15, the 90, the 50, the 118, and you're left with $42 of cash flow per month. Now, is that a good deal? Well, it depends. How much is the house? How much money are you having to put down? How much money are you wanting to get as a return on your investment? Maybe or maybe not. But this is probably an accurate number as to how much money you can really walk away with once you account for everything. Now, a few things to note here. Obviously, we're building this to be used as a template for any property that we're going to offer on. But again, remember, go back to the age of these things. If you're buying a roof or a water heater that's already 5 years old, then you already need to have set aside $600. So you may do that up front in an account, however you want to take care of it, but just know you can't always divide it by 10. You have to use whatever age the water heater is and how much life you think you have left in it. So something to note there. Thanks for watching, guys. I hope that you appreciate this information. If you do, hit the like button and subscribe. There'll be more coming your way. Next, we're going to dive into appreciation and tax benefits and the principal pay down aspects of owning real estate and how those add to this cash flow number here to really increase those returns. Also, if you like free money, sign up with the link down below, and Webull is going to give you 4 free stocks valued between $8 and $1,600 each. Just click the link down below, sign up, deposit $100, and they'll be sending you 4 free stocks. Thanks for watching, and until next time.